Welcome to Guide to the Global Economy, the first economics podcast from the Atlantic Council.
This is a podcast not just about economics, but also foreign policy implications that go with that. So if you're interested in politics, but maybe you got a B or even a C in Econ 101, this is a good place to be.
We're going to look at the intersection of finance, national security, macroeconomics. We're going to explain what it means, and we're going to do it in plain English. That's how we always do our work at the GeoEconomics Center. We want everyone to be part of this process going forward. We're all trying to navigate this reality in Washington and beyond, and our goal is to navigate it together. I'm Josh Lipsky. I'm the chair of international economics and co-host of this podcast.
I'm Sophia Bush. I work on Josh's team at the GeoEconomics Center, so just a disclaimer, because he's my boss, I am obligated to agree with about 75% of what he says here.
I think we can say for the podcast purposes, it could be 50%.
Okay, we'll say that publicly.
It's on the record now. So the first episode, Sophia, it was not a big debate when we wanted to figure out what to do. Washington and really markets around the world are consumed by the investigation into the chair of the Federal Reserve, Jay Powell. And when we're talking about Guide to the Global Economy issues that are at the center of politics and economics, this is the one where I think we have to dig into it because it's complicated and there's a lot of confusion about what's happening and most importantly, what might happen next.
Yeah, because we started talking about this over a year ago.
Yeah, we flagged going into 2025 that central bank independence was going to be the main issue, and that ebbed and flowed throughout the years. Some people may remember when Trump toured the renovations of the Federal Reserve building, him and Jay Powell in hard hats.
Yeah.
That Chair Powell actually corrected him on some numbers going forward. But really, the issue goes back further. It goes back to Trump's first term. People forget, of course, Trump nominated Jay Powell. He is Trump's Fed chair. Biden renominated him for a second 4-year term. And there was tension in the first term. There was tension over interest rates in the first term. There were fights between them. Nothing at the level we see now, but this is not just a second term phenomenon. But certainly once we got into the second term, with interest rates staying higher than Trump preferred, he made clear what he wanted on that front. And Powell saying tariffs were one of the reasons interest rates were staying higher, the tension boiled into conflict. What's so strange about it is, on the surface, reading what Trump says and others says, it's not only about interest rates, it's about the Federal Reserve building. Kind of a strange thing.
Right. But of course, Chair Powell has said, this isn't about that. This is about central bank independence, which I guess is more of an issue this time because Trump is just entering a different economy in the U.S. than his first term.
That's right. And we did not talk about inflation in the first term in any significant way. And given one of the reasons he was reelected was because of concerns over prices, inflation is now front and center of the agenda. So to the extent Jay Powell is on TV every 6 weeks when the Fed makes a decision saying we are lowering, we're not lowering, and tariffs are a factor in higher prices, this is something he's paying close attention to, and the American people are paying attention to in a way they weren't before. I mean, we should talk for a minute about this building situation.
Okay.
First of all, if people have been to the Eccles building.
I have not been to the Eccles building.
So the Eccles building is beautiful, but it is in serious need of renovation. So the idea that the Fed needed to renovate is not controversial and had been approved in bipartisan ways over years. It has been an expensive renovation. There's no doubt about that. But I think we need to ask ourselves, is this really about the renovation? At the bottom line, cost overruns in Washington are not a new thing. This is an expensive project. But if interest rates were looking exactly like Trump wanted them, would we be talking about this right now?
The part that's confusing to me, though, is if his term ends in May, why all of the effort to pressure him now?
Look, I think that there's two theories going around Washington right now about what's going on. The first theory is that Trump's angry at Powell and wants some investigation on that front, and the DOJ might be, listening to that, and this is, a follow-through. The other theory is that this is about a signal to the governors who are sticking around. Powell might be out in May, although it's only his term as chair that's up. His governorship could last another 2 years, so he could stay on the board. And even so, there's a lot of other governors there. And I think the debate happening right now is, what is the rest of the Fed? We always think about the Fed as just the chair and Powell makes the decision, but we all know that's not actually how it works. But I'm not sure if everyone understands that. This is a voting body, just not unlike the Supreme Court.
So you think it's more about just signaling and pressure to the greater body that it should be potentially more in line with Trump's view of the economy, the administration's view?
I don't know. I debate it because interest rates are going down. That's the thing. Maybe not going down as fast as Trump wants, but Powell has been cutting rates. The Fed has been cutting rates. So he's kind of getting the policy he wants, maybe not as fast as he wants it. So it is not clear cut exactly the motivations, and there may be multiple motivations here at the same time. Why does central bank independence matter? And my view of that is that central bank independence, and we can talk about this later in the episode, leads to better economies, leads to more jobs, leads to more growth. And I think the data is pretty strong on that point. But we do take it for granted, I think, a little bit in this country. I never thought we'd be having a conversation like this about central bank independence in the U.S.
I think there's a long way to go before independence is really seriously hamstrung.
Okay, so here's our first disagreement on the history of the podcast, Betty to come. And here's what I'll say. If I were to tell you a year ago, forget what's happened in the past year, but it's January 20th, 2025, Trump's been sworn into office, and I just say, Sophia, the chair of the Federal Reserve is going to be under criminal investigation because the president didn't think he lowered interest rates quickly enough. I think we would be thinking, what's the state of our constitutional system? What's the state of the markets, which we should talk about? But we're not there. You're right. There's been a concerned reaction in Washington, but not a panic in any way.
But I mean, maybe markets are right, though, because we haven't really seen much of a reaction in the bond market or the stock market, which means that anyone who's betting on the U.S. economy is not feeling that threatened on this, and they're putting their money where their mouth is.
Well, this is the debate I want to have. So what's your view on why markets haven't reacted that strongly over the past, since the announcement happened?
I think it's because there's still a lot of steps that have to play out. There's the grand jury that has to happen. We have to see if there's actually charges. So it's not like an immediate threat to U.S. monetary policy.
My view is that the markets are willing to rationalize anything. And even if we got charges...
Why would they want to rationalize anything? That doesn't make any business sense or investor sense.
Well, if you think AI is just going to carry the day no matter what, and we can have higher stock prices and have a higher bottom line, then maybe we live with a central bank that's a little less independent. And of course, less independent central bank carries long-term inflation risk because then it becomes more reliant on what the president wants. But I think markets might be willing to discount some of that for short-term gain. And
it's not just short-term gain, though, right? If the 30-year bonds aren't reacting.
But I don't know why the 30-year bonds aren't reacting. I think they should. I agree with you. They should be reacting more because let's say charges are filed. Let's just say in that scenario, okay. I don't think it's going to happen. But let's just say they filed charges. You could see a world like you're talking about where then the markets finally react. Well, this has gone too far. Or you could see a world that says, well, he's only out in May anyway. So that didn't make a big difference in terms of interest rates. And let's look at this renovation situation. And I just wonder how far the markets are willing to go to rationalize.
I think if we look at the past year, markets are going to wait until there's really concrete proof that things are going to go downhill. I think if you look at Liberation Day, when Trump started adding a lot of tariffs, we knew that was going to happen. Everyone knew that he was talking about doing that. They just didn't think it was going to really come to fruition. And I think it wasn't until you had really high tariffs on China that markets really started to spin out.
It's interesting because the only significant market shock of Trump's second term, think of all the things that have happened. We think of Doge in the beginning of the term, just Venezuela recently here in the beginning of the second year, but everything that happened in between, Iran strikes, the only significant market reaction was Liberation Day. Yeah. That was it. It was the reaction to Liberation Day. And then he changed the policy, although we could debate how much the policy ultimately changed over time. And then the markets went back up. But nothing else has shocked them. And that shocks me.
Yeah. I mean, that could just be the AI economy that we're living in, I mean, we've seen this. Well, you've seen this before, right? With like,
Yeah, I mean, I was around for the dot-com bubble.
I was theoretically around too. So paying attention.
I also was not paying close attention as a, let's see, in middle schoolish, high school.
Oh,
But thank you.
you weren't in the White House then?
No, I was not in the White House for the dot-com bubble. Thank you.
Sorry.
But speaking of history, it is worth saying that, central bank independence and challenges to it are not new in the United States. I do think a criminal investigation into a Fed chair is new, and we shouldn't underprice the significance of that. Nixon and Arthur Burns had fight. LBJ and his Fed chairs had fights. We just never got to the point where a Fed chair is under investigation. And I think the moment that matters for me, that will be remembered for decades, that all of us who care not just about monetary policy, but about the U.S. role in the global economy will remember, is Powell's statement that night when he came out and said, this is not about renovation, this is about interest rates, and this is about changing Fed policy. And I don't think anyone has been as clear of that. I'm not just talking monetary policy. I'm talking about law firms. I'm talking about Capitol Hill. No one has just said bluntly what they think is going on. And I was genuinely surprised by it. I'll be honest with you. When I first saw it, I thought it was an AI deepfake.
No.
I did, because I said, no way he just came out and said that. And I had to go to the Fed YouTube page to see that it was legit. I want to bring in Charles Litchfield, Director of Economic Foresight at the GeoEconomics Center. And Charles is going to talk to us about central bank independence outside the U.S. This is not just a U.S. phenomenon. So Charles, welcome to the inaugural edition of Guide to the Global Economy podcast. But you were the guest we thought of first when we wanted to talk about central bank independence outside the U.S., because when we've thought about central bank independence in the past, it's been about countries like Argentina and countries like Turkey. And that's really where the central bank independence debate has been, especially going back 2019, President Erdoğan, his fights with his central bankers. And I thought it'd be useful to hear from you any lessons we might learn from other countries' experiences.
Well, there are many lessons to be drawn on central bank independence. I think it's not an accident that this is a value that's emphasized as very important. One point I would make at the beginning is that the price you pay for undermining central bank independence lasts a very long time. It's not something that you can undo quickly and say, well, that was a blip, but now we have a central bank that's very independent again. The markets will assume, both inside the country but also outside, that now that that has been undermined, it could happen again. And the behaviors both of external market participants and internal market participants change. And it's very difficult then for the newly independent central bank, once independence has been restored, it's very difficult for them to appropriately address how to have the right incentives, how to remove, for instance, inflation, how to change people's behavior once that's been undermined. So you pay the price for a very long time once you've undermined the belief that you have an independent central bank.
Do you think that's different for advanced economies versus emerging markets?
Well, advanced economies have not had these experiments recently, so it's hard to say. But I think that basically you're dealing with the same factors. You're dealing with suddenly consumers and businesses not quite believing you when you say that the central bank is independent. You're dealing with them trying to second guess what the intentions of the political leadership are, rather than how the central bankers behave. And so I think the damage will be very similar. Developed markets benefit from some advantages that developing markets don't. So certainly there would be more cushions, but I think ultimately the consequences would be the same.
Can you just take us exactly what happened in Turkey since 2019?
So in 2019, President Erdoğan fired his central bank governor, Mr. I've written it down here, Çetinkaya. Mr. Çetinkaya, who was quite an orthodox central banker, and some would say that he wasn't orthodox enough, that rates weren't high enough given the inflation of the time. But he was fired because President Erdoğan over many years had developed a body of thoughts and ideas on interest rates that were unusual. His views range from justified within the tenets of Islamic finance, that charging interest for lending is not something that should happen, all the way to things that will sound more familiar to US listeners, which is that high interest rates actually cause inflation. This sounds a little bit unusual.
The IMF would agree.
Not just the IMF, but this sounds a little bit unusual because creating scarcity of money, which you do through high interest rates, should mean that inflation comes down. That's the orthodox view. But I suppose we all have to have some sympathy with the idea that if you want to localize production and you want to encourage producers to invest and borrow money so that they invest in localized production, you need the conditions for that to be favorable. And therefore, you need them to be able to borrow money at a competitive rate. Why do I say this is maybe familiar to US listeners? This is sometimes something that President Trump has said. We haven't seen enough investment and we haven't seen the repatriation of production into the US despite the tariffs because the interest rates are too high. And he said that on several occasions. Well, President Erdoğan was of a similar view in the 2010s. There was already some implicit influence over the central bank during that period, but the first time a central bank governor was fired under President Erdoğan was in 2019. And this already created a lot of problems. Inflation went up because you started seeing the markets not trusting what was being said. Also, of course, because the new central banker who was beholden to President Erdoğan brought interest rates down because that's what he was put there to do. So inflation goes up. Then you have COVID, which makes things much more complicated.
Was this the family member?
No, that was
later.
No, it was at the same time. And so you had, yes, of course, that did compound the suspicions of sort of family bias and not a bias towards competence. But you're talking about Mr. Al-Bayrak, who is President Erdogan's son-in-law, and he was appointed as finance and treasury minister during the same period, 2018 until 2020. So there was one reaction to this when things got really quite difficult to handle during COVID. Turkey depends a lot on inflows of capital thanks to tourism. That didn't happen in 2020 because of the pandemic. And so they had to react to this and bring in a more orthodox team. And they did so in 2020 with Governor Akbal. And so you did see some of this pressure subsiding. But Governor Akbal only lasted, I think, 8 months. And so a second governor was fired. And then again, Mr. Uysal, so a more compliant governor, was brought in. And so basically you can date the period of unorthodox monetary policy starting in 2019 and ending in 2023, when President Erdogan won re-election. Many people thought this would mean a continuation of the policies, but then he brought in an orthodox team. And at the GeoEconomics Center, we know this team well. So that's Finance Minister Şimşek and now Governor Karahan. There was an interlude where the first woman governor was appointed, who was also quite orthodox, Governor Erkan, but she's now been replaced by Governor Karahan, whom we know well. So now you have an orthodox team. But this brings me back to the point I was making at the beginning, that it takes a long time for the orthodox team, orthodox though the policies may be, to rein in inflation and change people's expectations. And so currently in Turkey, you have an interest rate of 38%, very high. But inflation is still at this point at 58% annualized. So lower than, so usually in textbooks, you're meant to have a one-to-one response or a higher than one-to-one response to inflation. And so that would dictate that interest rates should be higher. They always say that ex ante, so by next year, in fact, interest rates will be higher than the inflation rate will have been by then. It's always the point they make. They made it to us exactly a year ago, but then they say inflation has been caused also by earthquake spending, which is fair enough. So it's very difficult, very time-consuming, to change people's expectations once you've broken the rule on central bank independence.
So, Charles, I think you've convinced me that Sophia was right in the beginning of the podcast, because I was somewhat alarmist about central bank independence. But when I think about the Turkey experience, I see more differences than similarities, at least in terms of where we are now in the U.S. And part of that's because of an advanced economy versus emerging market, but part of that's because...
Well, so we haven't crossed the thresholds yet. The U.S. president has not so far fired a central bank governor. And I think that was really what unleashed this period in Turkey. There was influence and pressure beforehand. It's important not to be naive about that. But I think what external and internal observers remember, and agents within the economy who are adapting their behavior to what they see, the big water-breaking moment was firing the first central bank governor, then going orthodox again, and then that new orthodox governor only staying for 8 months, and then him being fired again. And so I think that's the problem that we do not yet face in the US, because none of these precedents have been created yet.
So do we think there's sort of a double standard where it takes much more than signaling to really lose confidence in a central bank, but takes a lot more, I guess, a lawyer would say, burden of proof to prove that independence has been regained?
Yeah, I mean, I think this is the case for many things in economics. It takes a long time to build a series of positive expectations, to build a reputation.
Mm-hmm.
But a reputation can be destroyed in a few minutes. So I think that's the principle that we're dealing with. I'm not sure it's necessarily double standards.
Mm-hmm.
It's simply that creating a positive expectation and creating the sense that you're dealing with an institution that's objective, by definition, takes time.
In Turkey, you had central bank independence challenged. You had it challenged for a period of years, and then you had a reversion to orthodoxy.
Mm-hmm.
In the U.S., we don't know if we're on that trajectory. We're challenging central bank independence, not at the level Turkey did, and we may continue to challenge it through a new Fed chair who is seen as closely aligned with the president. So I just wonder about that path.
Well, it brings me back to the point I was just making, that you can undo a reputation much faster than you can build it. And I think this is a risk that US policymakers should really bear in mind. Some of your question reminds me of some of the things Turkey had to do in its unorthodox period. Just because you've created a new series of tools that are somewhat unorthodox, that involve low interest rates, suddenly you see all sorts of problems popping up over the economy, some imbalances, some lack of inflow of capital that you're dependent on, the exchange rate behaving in an unusual way. And then you find yourself creating all sorts of compensations for this and sticking plasters that aren't necessarily that useful, or that don't create long-term incentives that are good. And so I think this is something that we need to bear in mind even in the US. So I think the president and the central bank leadership, when it was unorthodox, all knew that their policy would lead to a depreciation of the currency, which is perceived negatively by Turkish public opinion, which likes low interest rates but doesn't like having a weak currency. And so then they created these very unusual savings accounts where you had an incentive to save in the local currency. And if the local currency depreciated further, you would be reimbursed for that depreciation, which meant that the central bank had to step in and just sort of shower these accounts with cash. So in the US, I think going down this path where you embrace an unorthodox policy for some sort of short-term gain, but then you have to start creating all sorts of sort of parallel structures and new institutions and new savings accounts, for instance, to reassure people when the dollar depreciates. Now, the dollar is a much larger market, and people trading with the US have an incentive to keep their prices competitive. But this is sort of the point I'm making, that if you embark on this path, you will find yourself having to create new instruments and all sorts of new things that have long-term consequences. So it's better to think twice before doing so. But your question was sort of about, it was a simpler question in a way. It was, if we go down the unorthodox path and then we become orthodox again, what does this mean? Brings me back to the first point I was making. It takes a long time to rebuild a reputation. Turkey's going through that right now.
Charles, thank you for being with us. We appreciate you being on the inaugural episode of The Guide. Thank you to everyone for listening, and we hope you stay tuned for what we have coming next. Subscribe to the podcast anywhere you could find podcast.
And I'd also say we'd love to hear your comments. If you disagree with us, do you agree with me more than Josh, or the other way around? Let us know.
Yeah, I would also like to know that.
Yeah. Thanks everyone for listening.
Thanks everyone.